Hello, this is Bob Joyner, and this is a review of Friday, looking at the SPY, July the 5th, 2024. And in today's video, we're going to be looking at two major things. The first thing is how to trade and how to see moments of extreme volatility and how to play those periods. And then also the second thing I want to look at is 0-day expirations on the SPY. And just in case you've never traded these before, or you've never looked seriously at trading the same day expiration options, I want to show you some examples to show you what the potential is there. So those are the two things I'll be covering in today's video. Hope you find it interesting. So let's go back to the charts here. And I've mapped out this area about a 30-minute period in the morning market for Friday. And as you can see, this is what you're looking at here is on the right. This is a 1-minute chart. This chart over here on the far right, I'm using conditional colored candles. So what that means is all of my red candles, they actually have 6 different gradations of red, and the green candles have 6 different gradations of green. And so extreme periods of extreme stretch, I guess we could say, would be dark red, as you can see here in these periods in this box, and then extreme long to be dark green up here in the top of the box. So one of the first things you look at when you're looking at these charts, and this is the 1 minute again on the far right using conditional colored candles, 5-minute chart here in the middle panel using Heiken-Ashi candles, and then this is the 1 minute over here on the far left using Heiken-Ashi candles. So for this video I'm taking away the 26-minute chart for right now so that we can focus on these 3 panels. Inside the chat room, of course, you have 4 different panels available to you for viewing, all 4 panels. So during this period, let's look at a couple things. Yesterday I talked about the importance of the 5-minute half line. So this 5-minute half line during this period right in here, this blue line that I'm painting right in here is the 5-minute half line for this period, for this 5-minute candle right there. So normally we would be trading looking to stay above that. And as you can see during this period right in here at the beginning of that, we had a little bit of a flip down. If you look on the far left panel, the 1-minute Heiken-Ashi candle, you can see where price fell below that line. So normally that would be a reversal, okay? But you always have to look at the context. You have to look at support and resistance, okay? The same thing happened before when we were on the 5-minute chart. Okay, if you look up at the top, as we moved up here, this 5-minute candle is right here, and again we broke below that 5-minute half line as well. Normally that would be a reversal situation. Okay, so that's the first part, because I talked about the 5-minute half line yesterday, and if you played that strictly, then you'd be seeing a lot of chop. You can trade it, but it would be very choppy if you didn't see the larger context of things. So there were a couple things that happened. The first thing I want to point out, which is the most obvious thing of all, is that in pre-market, down in here, we had this period in which you can see all the pin bar candles on the 5-minute chart. And you can see on the 5-minute chart here where, 9 a.m. and all the way through to the open, we kept dipping down into this line. That blue blue line is the yesterday's close, right around 551.50. And you can see those little candles just dip down in there, dip down and bounce back up, dip down and bounce back up. And that's enough, really. If that's all you see, and you see that happening, then that can be enough for a high probability trade situation. But what I want to point out to you is this. When we had the break of that first 5-minute half line right in here, okay, and we came down below that area over here on the far left, you can see the 1-minute chart. At that same time, our CCA indicator, which is this indicator right over here, okay, you can see how it's bearish, 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 and then it drops down. And what it has dropped down to is below that third green line. It went below -10. So again, if you're not using my charts, you've got to figure out your own ways of looking at volatility and looking at momentum. But basically the CCA you should think of, if you're trading my charts, you should think of it as a momentum indicator. So at this point, this is an oversold, very bearish momentum, right? But it's overextended. It's overextended, and I'm saying that because it has dropped down to -0.15 at that point, which is extremely low. And you know that because it hardly ever happens. Okay, so you know that's an extreme move. And unless there's been some news event, which there was not at that point, unless there's some surprise news event, then that's a radical departure from what's been happening on the charts, and therefore you should pay attention to it. Unfortunately, for new traders especially, what often happens is you see that big drop and you probably stop out of your long trade, and then you try to reverse because you think the market has turned, and yet right when you're getting into it, because it looks so bearish, doesn't it? Everything's red, it looks bearish, but you're not seeing the areas of support in this case, and so you don't know that this is an extreme move and it's a high probability long situation. So in light of that, what I want you to do is I want you to look at the right panel over here. These are the conditional colored candles on this far right 1 minute chart. And as you can see inside this yellow circle that I've drawn where we qualified as a short, sort of beneath that blue line on the Heiken-Ashi fractal line, we also had dark red candles. Those dark red candles are showing you an extreme bearish move looking for support. I mean, it's hunting for support. Think of it that way. It's not a reversal usually. If you have a series of dark red candles and the price continues to go lower, that's different. This is not the case. These are a couple of dark red candles, and it is at a line of known support, which is the morning area, the 551.50 area, which we continued to bounce off of. So this was just an extreme pullback down to that same area. And if you don't see that, then you freak out. You don't make the right decision. The right decision at that point is to add to the position. Whether you're trading options, whether you're trading futures, the right choice at that point is to add to your position and add boldly. So after that bounce off of that 551.50 area, we come up to the top and we come up to this area up in here, which is the R1 line, right? And if you look at that, then you look at, and we have dark green, you probably barely make it out. We have dark green candles, which means we're actually overbought at that point. We have the CCA at that point stretching up to that third line, if you can make it out on the far left here, that third line that I've got designated. So again, price is pretty overextended. You could actually short at that point, and that would be definitely a good short at that point of possible resistance, right? And you could have taken that as a short back down. But then the main thing is this area back down here where we drop back down again, dark red candles in the same stupid area of possible support. Again, what you wanted to be doing at that point is adding to the trade and adding big time. Don't think small. Don't think if you had 2 contracts, let's say, or whatever, earlier before, and now you're holding a loss. At that point, you actually want to add at least 2 or possibly more contracts to make because this is an ideal entry position. If you think of it, this is an extremely high probability entry situation, even though to the naked eye you may not think that. If you're not seeing this area, this green box of support, then you're not thinking that. You're thinking, oh my gosh, I'm losing money. Oh my gosh, right? But actually, this is an opportunity in disguise. It's an opportunity for you to get into this trade at a great position and make a beautiful high probability entry with a lot of equity in order to trade that back up. Now, where would your stop be? Your stop would be if that line of support, that box of support, if you will, if that does not hold, then your stop is going to be below that, right? Okay. But and so your stop would still be tight. You don't add in willy-nilly and thinking, well, I don't have a stop. This is the high probability dark red candles at a known area of possible support, a high probability area of support, since we had been tagging that price area probably 6 or 7 times since pre-market. All right. So that's the first thing I want to talk about. Sorry it took so long, but important to talk about. The next thing I want to talk about is same-day expiration options. Okay, and I'm going to expand this out. I'm going to get rid of all these drawings, and then I'm going to come back and show you the possibility with same-day expiration options here. Okay, in this little portion right here, I'm going to show you talk to you about same-day expiration options. So when you look at SPY options, you have the choice to go out 3 or 4 days. You can go out a couple of weeks, a couple of months, but you can also go out just the same day. So today was the 5th. So the options today, same-day expiration options, means they expire at the end of the day on the 5th. Okay, so you've got to get in and out of that trade in the same day, or else you're going to lose. Okay, um, so I just wanted to show you the value and the degree of volatility with these things. So for example, here right after the open, 64 cents was the price of the let's see, which was it? Yeah, the 552.50 call for the same day expiration options was 64 cents, and you can see we made a little move up to 77 cents. Not a bad gain. Of course, you're buying at least one contract, 100 times 64, so that would cost you 64. You'd make 77 bucks. So the way to think about same day expiration options is not so much that little bit of a price, but it's the degree of profit, the return on your investment for the time invested, especially. So for example, 64 to 77, only 13 cents, but you multiply that times several contracts, then it starts to get a little bit interesting just for starters. But the main thing is this 13 cents off of 64 cents, and that's what, probably 15% gain within a couple of minutes. All right. Price continues to go to 86, so from 64 to 86. That's probably what, about a 30% gain or something like that. I didn't figure it out. But then we had that big retracement, and I've talked about the big drop down in price where we came back to this area of support, the 551.50. The price of that call at that point, the 552.50 call, same day expiration, was 56 cents. And within about 15 minutes, it had gone up to 95 as we went right back up to the R1 line to retest that area. So that's a gain of what, probably 90%, something like that, in just about 15 minutes. So again, think in terms of ROI, think in terms of where else can you get that much of a percentage gain on a trade in that amount of time. You're probably thinking penny stocks. Maybe if you're lucky and you get an exactly good entry on a penny stock, you can get that kind of gain. But here it is on SPY options, and it's readily available for you. So same day expiration options. Let's continue to move the chart forward and see what we see. So we had that other little pullback. Again, we dropped down to 64 cents, came right back up to R1 again, $1. So you could have played this pinging trade here back and forth, and that would have been the appropriate way to take it. Go long at 56, get out at 95. Go long at 64, get out at $1. Okay, you can do it that way. You can also, be adding to that position, because you see that on the bottom here on this 5-minute chart, you can see how the CC, which is Copic curve, based on the settings that I use, Copic curve is staying bullish through this whole thing, and that's another reason why I expected this area to be support. Not only was it previous support, multiple bounces off that line, but it was also occurring within the context of a very bullish, not very bullish, but at least a bullish Copic curve down here on the bottom, right? So I know from experience, from having traded these charts for years and years, that that's a high probability long situation. It's overextended sell-off within the context of a bullish market. Okay, boom, boom, profit, profit. So that's one way to do it. The other way to do it is to add to that position over time. It's not typically what I do, but I'm saying it's out there for you to do it. The other thing that's out there for you to do is to hold that trade. Now, what typically works best, I think, okay, you can trade however you want to. You can do scalping on these same day expiration options, but you can also hold them for larger gains. So as we move forward, you can see the price, that 64-cent option has now doubled in value, more than doubled in value, up to 140 there just before noon. Price continues to go up that same option without ever doing anything at all, just sitting on your back end. You're up to 172 now. You've almost tripled the value of your investment over that short period of time. Okay, and we went up a little bit higher than that, but not a great deal. Okay, but that's just trying to show you the power of these same day expiration options. You do have to be careful, and I put some information in the description box below this video about the risk and the opportunities of trading same day options. And this is by no means an extensive lesson on that, but I do want to point out to you, and if you look at the CC down here on the bottom again, we had that little dip right here around 1 o'clock, and just boom, went right back up. But the whole time, two lines that are also on my charts, on this 5-minute chart, one is a 27 EMA. That's that blue line right there, offering support and a bounce every time it comes back, and VWAP, which is down here below. And in this case, what you'll see is a separation of the 27 EMA from VWAP. So we have this divergence going on. Think of that kind of as a MACD type indicator if you want to. We have this very bullish divergence where the 27 EMA continues to outpace VWAP. We never even get close to VWAP on this 5-minute chart. Covered a lot of ground in this video. It's much longer than I usually want to go on these daily video recaps, but there was a lot happening on this light volume trading day, and I wanted to cover those while they occurred so that you could sit back and reflect, and also look at your own trades in light of this information and see how you performed today, how you traded today in light of that chart that you're looking at right here. All right. Hope this video has been helpful for you. Please, as always, like, subscribe, and there'll be more videos to come. See ya.